How to invest $500 to $1,000. This is an interesting topic because I'm going to be making a lot of assumptions. If you have $500 to invest, which is a good amount of capital, but it's still a low amount of capital if you look at the long term of your investing journey, because eventually you will want to invest more than $500. But if you have 500 to 1,000, what I want you to take away is the thought process, is the fundamentals. Your situation is more than likely different. So you might have less than $500 to invest. You might only have $300, or you might have more than $1,000 to invest. You might have 5,000 or even $10,000. When I started out, I had between $5,000 to $10,000 to invest. But like I said, you can take this information and then apply it to your own situation and start building your own wealth. So some of the things that I want to talk about are going to be stocks, ETFs, bonds. I'm going to skip the index funds because with the more popular index funds, you're going to have to put down a large amount of capital just to start investing in them. For example, if you take the popular Vanguard S&P 500 index fund, which is the VFINX, the minimum amount is $3,000 to start investing in that fund. So that's why we will leave the index funds to the side and we will focus on the ETFs. I'm also going to look at aggressive and conservative portfolios, both $500 and $1,000. We'll also talk about diversification and how you can be emotionally sound when you invest in the stock market. We'll also talk about crypto a little bit, so let's just jump in. So I have my handy list of portfolios with me, both $500 and $1,000, broken out between aggressive and conservative. The first one we will look at is the aggressive $500 portfolio. Now, when I say aggressive, I'm talking about how risky and how risk averse are you when it comes to investing. Because the more riskier investments are going to be stocks. Fixed income assets such as bonds are going to bring stability to your portfolio. So in a bull market, everything is looking great, stocks are shooting up. But in a bear market, stocks are dipping down, and your bond, your fixed income assets, that will provide stability to your portfolio. The first thing that you want to pay attention to when it comes to your $500 aggressive portfolio is the VOO ETF, which is the Vanguard 500 Index Fund ETF. You want to buy one of them. Currently, it's priced at 366. And the Vanguard S&P 500 is a index of the 500 biggest companies in the US. The next one you want to look at is the VX US, which currently is only about $52. You only want to buy one share of that ETF also. The VX US is the Vanguard Total International Stock Index Fund, ETF. And since this is a total international ETF, you're also capturing high quality companies outside of the US. The last ETF that you want to have in your $500 aggressive portfolio is the BND ETF, which stands for the Vanguard Total Bond Market Index Fund ETF. Now look at this. So we have the 366 for the VOO, $52 for VXUS, which is the International Stock Index Fund ETF, and then you have $72, which is what one share of BND costs right now. If you break it out by how risky your portfolio is, your fixed income assets, which is the BND, is 15% of your portfolio. Now the other 85% consists of stocks, both the S&P 500 stocks and then also the international stocks. So with the S&P 500 ETF and then also the VXUS, which is the total international ETF, you have that immediate diversification in high quality companies. And then with the BND, you have that fixed income asset that provides stability to your portfolio. Now, this is an aggressive portfolio because only 15% of your portfolio is in a stable fixed income asset, which is the BND. And if you add up all these three ETFs, you'll pay about $490. So you still have $10 left to buy a fraction of a share, or you can also invest it into crypto. If we move over to the conservative $500 portfolio, we're going to make some slight changes. So we're going to keep the VOO, that's the foundation of your portfolio, and we're going to buy two BND shares, which will bring your fixed income assets to 28% and your stocks to 72%. If you add this all up, you get a little over 500 bucks, you get $510. The reason why this is more on the conservative side is because you have 28% of your portfolio in a fixed income asset. The way to think about fixed income assets, I like to use the John Bogle method. This method says that whatever your age is needs to be your percentage in fixed income assets such as bonds, certificates of deposits, savings accounts, etc. So when we look at the bonds, I'm going to take 30 years as the average. I'm assuming that we are all 30 years. Now, depending on how risk averse or how risky you want to get with your investing, you don't need to put 30% in bonds. You can go even less or even a little bit more. So let's say you are 30, but you only want to have 20% in fixed income assets. Just tailor your portfolio to hit that correct percentage. Now, like you have already noticed with the conservative portfolio, we got rid of the total international ETF. If we now move over to the aggressive 1000 portfolio, now it gets a little bit more fun, a little bit more interesting, because we're going to introduce some individual stocks. So we're still going to keep the same ETFs, but we're going to add some additional stocks to it also. I want you to add 2 growth stocks and 2 dividend paying stocks of your choosing, but make sure you still hit that $1,000. It's fine to go slightly over or slightly under, but try to keep it in that $1,000 range. So in my list, we have FIOO, which is the foundation of the portfolio. We have 1 FIX US, which is the international stock ETF. We have 2 BND. We have 1 Tesla, which is a growth stock. We have 1 Amazon stock, also a growth stock. And then we have 2 dividend paying stocks. The first one is Realty Income, and the second one is Nike. So looking at the cost, FIOO $366, FIX US $52, BND, since we have 2, $144, Tesla $194 currently, Amazon $99, Realty Income $64, and Nike $105. If you add all these up, you're a little bit over 1,000, you're at $1,024. But like I said, these are the 2 individual dividend paying stocks and growth stocks that I choose. You can switch them out and pick your favorites. With the aggressive $1,000 portfolio, also similar to the aggressive $500 portfolio, the aggressive one, we have 14% in fixed income assets because we bought 2 BND ETFs. Moving over to the more conservative $1,000 portfolio, we're going to keep the same stocks and ETFs, but we're going to make some slight changes. What I'm going to do is we're only going to have 1 growth stock and 1 dividend paying stock. And we're going to go up on our fixed income asset because we want to get it into that 30% range. So this is what it will look like. We're still going to keep FIOO 1, which is 366. FIX US, we're going to keep 1. We're going to up BND from 2 to 4. We're going to have 4 BND ETFs. Tesla, and I'm keeping Realty Income. Realty Income is a monthly dividend paying stock. So you'll have the benefit of seeing monthly dividend payments deposited in your account. With this conservative portfolio, your fixed income assets, your bonds, are at 30%, and then 70% is at stocks. If you add up all your capital, you will spend about $964 with this conservative portfolio. So you still have a little bit of leg room. You still have a couple of dollars to invest in a different security. With the portfolios that I just talked about, you can take those, both the aggressive and the conservative, and then apply it to your own situation, of course. So you might want to fudge some of the numbers a little bit, maybe switch out a stock here or there, and then make it your own. You might be thinking, okay, I like these portfolios, I'm ready to start investing. Where do I start? Nowadays, it's extremely easy to start investing because all you need is a brokerage account. Some of the more popular ones are going to be Robinhood, Ally, TD Ameritrade, E-Trade. You have a plethora of options. All you have to do is go to the particular website, fill out your information, get your login information, deposit your capital, and you're ready to go. Make sure that you only invest when you're starting out during business hours. Don't trade during after hours, either pre-market or after the market closes, because that's another level of risk that if you're just starting out investing, you don't want to mess with. Another cool thing about brokerage firms nowadays is that you don't have to pay commission fees when you buy or sell shares. Back when I first started out investing, I had to pay $5.99 to $6.95 just to buy and sell stocks. But nowadays, brokerage firms have different ways to make money. such as order routing, but that allows them to give you commission-free trading. And even if you have less than $500 to invest, you might only have $100 to invest. Still go ahead and start investing because you can buy fractional shares. So you don't even need to buy a whole share. You can buy a fractional share of, let's say, a company such as Apple or even Amazon. If a company pays a dividend, if you buy a fraction of that share, you also get a fraction of that dividend. So even if you only have 50 bucks, 100 bucks, you want to invest in Coke, but you don't have enough money, go ahead and buy the fractional share, and then you also get that fractional dividend. Another good thing about investing with a low amount of capital is that emotionally you'll be able to handle the ups and downs of the stock market. Because if you only have a small amount of capital invested, you're going to be less inclined to make immediate decisions when it comes to selling stock when you see the value of your stock dip down. Now, what's not going to happen with only $500 to $1,000 is that you're not going to become a millionaire overnight. So you do have to be realistic when it comes to investing a small amount of capital. There are stories out there where somebody had only $10,000 to invest. They started investing in penny stocks or they started doing some day trading and they became millionaires. You have to be skeptical when you hear those stories. Is it possible? Yes. Is it probable? No. It's best to look at investing as a long-term journey. So you start out with a small amount of capital, might be 100 bucks, might be 500, might be 1,000. You invest your capital, you learn the process of investing, and then you just add more capital to invest on a frequent basis. Also called dollar cost averaging, but that's how you want to approach investing. Don't look at it as a get rich quick scheme. Look at it as you're building your wealth over the long term. And when you're starting out with a small amount of capital, you'll be able to go through the ups and downs because it's fine to make mistakes. Everybody makes mistakes, even myself. Every now and then, I might buy a stock that ends up being a dud. But since I'm diversified, I have my capital in multiple securities. Even if I take one hit, overall, I'm still sleeping fine. You might also be thinking, you know what? Forget the stock market. I'll take my $500 to $1,000 and I'll invest it in the crypto market. I'm always going to be the type of person to tell you, yes, go ahead and do it, but make sure you take calculated risk. Because even myself, I'm also invested in the crypto market. What I would recommend is that you have a separate budget for the crypto market. So keep them separate. Make sure you invest in the stock market, but then if you want to, you can also invest in the crypto market. And just keep in mind that the crypto market is also a lot more speculative than the stock market. Because even if you look at the stock market, when it comes to some of the companies that we invest in, the price of the stock should be based on the earnings of a company, how well the company is performing. But when it comes to the crypto market, there are no underlying metrics that you can analyze in order to figure out how much a crypto is actually worth. So it's all based on speculation. So you're ready to invest your $500 to $1,000. Make sure you give yourself a pat on the back because this is a big deal. You might not look at it like that. You might think that, oh, I'm only investing a small amount of capital. But don't look at it like that because it's a mindset shift. You're doing something totally new. You're starting to invest in the stock market. And also, you might like it so much and get addicted to it, but in a good way, that you will try to find other ways and other methods of generating some capital in order to invest in the stock market and start building your wealth. Make sure to like this video if you like the topic on how to invest your capital. And then also leave a comment about which portfolio you like better, the aggressive one or the more conservative one. And of course, make sure you subscribe to my channel and I'll talk to you guys in the next one.